Welcome to Module 8. Today we're going to be talking a little bit about equity recognition and owner financing. We're slowly working ourselves through the income statement and balance sheet. We've spent the last few weeks talking about operating assets, operating liabilities, and the operating section of the income statement. And today we're going to be talking a little bit about owner financing as it relates to contributed capital, and you see that in a variety of forms. You see that in common stock, preferred stock. We'll talk a little bit about convertible securities that the management teams might issue, the different components or features that are associated with preferred stock, and transactions that also affect our equity accounts, which might include split-offs, spin-offs, and other equity carve-outs. So when we look at the stockholders' equity section of the balance sheet, you'll see that it's divided into two components: contributed capital and earned capital. So when you start up a business as an entrepreneur, something's got to make that business go, and it's usually the owner opening up his or her wallet and taking out a bunch of cash, opening up a bank account, and then beginning to write checks from that bank account for inventory, for personnel, for wages, for salary. All that initial startup money is referred to as contributed capital. And then as the business begins to take off and garner some traction and earn a little bit of profits, net income, that flows into the balance sheet as retained earnings. We call that earned capital, and that in turn can be used to finance future growth. Notice here on slide number 3, earned capital is referred to as retained earnings, and there's another distinction that we've referred to in prior modules called accumulated other comprehensive income, which is a line item below net income. You'll see other comprehensive income, and that's a line item that FASB allows inside of GAAP for very unusual items or items that are not associated with the day-to-day activities of the company that they want to segregate in some way. So these might include gains and losses from defined benefit pension accounts. These might include the translation effects of foreign currency being translated in the balance sheet. These might include gains and losses for available for sale securities. These are unusual enough in nature, or the magnitude of these movements might be so large that FASB has determined that it's appropriate to segregate them below net income so that analysts like ourselves can get a better feel for the ongoing day-to-day activities of a company. Notwithstanding, they do affect the economic reality of a business, and even though they might be big, and even though the foreign currency effects, for example, might have a neutral effect over the long run, in any particular year, they can have an outsized effect on the income statement. And if other analysts aren't paying attention to this because that line is below net income, then that creates an opportunity for us. And that's an opportunity that we all need to be aware of when we're looking at our assigned companies for our semester projects. So I'll point that out here a little bit more in a later slide. And then lastly, on this stockholders' equity page, we talk a little bit about non-controlling interest, which we've touched on several times this semester. It's very, very common, especially for larger firms like you all are covering in your semester projects, to have engaged in transactions in the past whereby they may have purchased a controlling stake in another entity. And in so doing, there are minority shareholders that still own part of that entity. And as such, there are minority shareholders that still own part of the companies that we'll be analyzing. So at the end of the accounting cycle, when we report net income, they have a claim on that net income. Part of that net income belongs to those non-controlling shareholders. And you'll see that reported on the income statement. You'll see total income, and then you'll see income attributed to non-controlling interest. And you'll see the same thing on the equity statement of the balance sheet. You'll see total equity, and then you'll see a deduction for equity associated with non-controlling interests, and then you'll see a net amount for equity associated with common shares outstanding. And we'll take a look at how that's presented on the balance sheet here in Exhibit 8.1. We have the balance sheet for IBM, broken out between contributed capital and earned capital. Let's take a look at that contributed capital section. This is a typical presentation, and as with anything else, you'll see this presented in a variety of forms. We've stumbled across this in a multitude of different fashions this semester already, where companies have some latitude with regard to how they present these numbers. But generally speaking, you'll see contributed capital presented as common stock, and a par value will be given, and then another amount that's labeled additional paid-in capital will also be given. Think of the par value as the face value. When we looked at bonds in Module 7, the face value was the principal value that a bond holder could expect at the end of the term to be repaid. Well, you can think of the par value of a common stock as similar, although the par value is never going to be repaid like the principal value will of a bond, and therefore it becomes rather arbitrary. The number that we print on the face of a common stock has very little relation to economic reality at this point in the normal operations of a company. So you'll see values of a penny, you'll see values of $1. In this case for IBM, we're looking at a value of 20 cents. What really matters is the par value plus the additional paid-in capital that will show up as equity on the balance sheet. So let's take a look at IBM in this case. You have a 20-cent par value and additional paid-in capital of what looks like well, in this example, they're lumped together, and you would probably have to dig into the footnotes to find out how they've been separated. Although you can do the math here and back into it a little bit. Authorized shares are 4.6 billion. Issued shares as of 2012 were 2.1 billion. So if each of those 2.1 billion shares have a par value of 20 cents, then that's, do the math, the difference between that 20 cents times 2.1 billion and the total equity here of 50 billion is going to be the additional paid-in capital. Below common stock, you see treasury stock. Treasury stock transactions occur when a company engages the public markets to buy and or sell shares of its own stock. And this is common for a variety of reasons. An optimist would say that a company's management team has the best insight into the true value of a company. So when you see a management team engaging in stock buybacks, that ought to be an indication that that stock is undervalued, and they recognize an opportunity to step in and buy it on the cheap. That's how markets should work. I say that's how markets should work because what we actually do see in practice are treasury stock buyback engagements that take place periodically without seemingly any awareness of what the stock price is. And you also see this with management teams who want to decrease the number of shares outstanding. When you decrease the number of shares outstanding, you increase the earnings per share. And that's just the math of it. So if you have here again, that's why we start the semester off with a proxy assignment that looks at how all of our management teams get paid. Because if management compensation is linked to earnings per share, then this is a pretty easy maneuver or easy lever that any management team can pull to get themselves paid. So just like with anything else that we look at this semester, I want I want all of you to consider how these financial transactions and how these accounting statements influence the ratios and in turn influence the pay packages of our management teams, because it may be an indication of an undervalued stock, or it may just be an indication of something else entirely. So let's learn to read through the tea leaves and gain a better understanding of what's truly going on. So walking through the balance sheet a little bit here, underneath contributed capital, you see earned capital, which includes the retained earnings and the accumulated other comprehensive loss. Underneath earned capital, you have the non-controlling interests. In this case, IBM has non-controlling interest of $124 million, and then lastly, the total equity. Same thing for P&G's stockholders' equity, only with this balance sheet. I'll point out here that they have several classes of stock. So Procter & Gamble has convertible Class A preferred stock. They have non-voting Class B preferred stock, and then they have common stock. So with preferred stock especially, I want you to think of that as serving a variety of needs for a company. Imagine that you own a company and you need to raise capital, and you've poured your blood, sweat, and tears into this company, and you see an opportunity in the marketplace to go attack a new region, for example, but you need startup capital in that region to employ sales staff and get an office off the ground, and you're going to have a little overhead. Well, how do you go about doing that? Well, you could issue common stock, but I can tell you right now that any entrepreneur in the world is reluctant to issue common stock, because it also means you're letting somebody else into the business. They're gonna have voting rights associated with that common stock. So oftentimes what you see is a company that will issue a separate class of non-voting preferred stock. So this creates an opportunity for an entrepreneur to go out and raise capital, but it's non-voting, so a management team retains control of the business, and in exchange for that, the preferred shareholder will require some compensation. So there will be some dividend associated with this preferred stock, some negotiated participation in the upside of the business, some preferred treatment in the capital structure in the event something goes wrong. All of these are what we call negotiated terms that will be clearly spelled out in the offering memorandum or the prospectus that comes with the preferred stock. So these are all very unique, and as you get into the analysis of your company, I want you to train yourself when you're looking at the capital structure of a firm to employ all of the valuation techniques that we cover this semester. Employ all of the analysis techniques that we cover in this semester, insofar as they require digging down into the transactions and the nature and the treatment and the classifications and the estimates and so on and so forth, as it pertains to the common stock. Understand what the common stock is worth. Value the common stock. And then the next exercise becomes taking a look at that capital structure to see if one or more of the preferred stock or the debt on the balance sheet might be more appropriate for you as an individual investor, given the relative risk-reward trade-off associated with each and its underlying prospectus, and meaning the negotiated terms of that particular preferred stock or equity. So moving on down, P&G's statement of shareholders' equity here. You have their additional paid-in capital. Then you see this line item called Reserve for ESOP Debt Retirement. So ESOP stands for Employee Stock Option Plan. And just like with everything else that we're going to see this semester, to really understand this, you're going to have to dig into the notes of the 10K and find out what the negotiated terms were when that ESOP bought part of that company. So the Employee Stock Option Plan was created. These are typically created under their own, a separate trust document that will be prepared by the ESOP's attorney, by the employee's attorney. and then they go to the bank. And that separate entity, that trust, will borrow a bunch of money from the bank, and they will take that money and they will buy back part of that company. And because this is a transaction that the company agrees to, here again, there will be negotiated terms associated with it. So this ESOP has a bunch of debt that they're using to buy company stock, and the company has reserved on its statement of shareholders' equity an amount that's for the retirement of that debt. So think of this as monies that the company has earned over time and set aside in a special bank account to retire that debt. And then for further detail, you're going to want to dig into the footnotes of the 10K. Next, we have accumulated other comprehensive loss. We'll talk more about that. Treasury stock, retained earnings, and non-controlling interest, all of which we've already mentioned. So 2 types of stock. Let's look at some terminology that we need to be familiar with. 2 of the most common attributes associated with preferred stock are dividend preference, meaning that preferred shareholders, in exchange for oftentimes giving up their voting privileges, will get a preferred treatment when it comes to the dividend payout, meaning they get paid first. If there's not enough money for everybody to get paid, meaning preferred and common shareholders, it's the preferred shareholders that will get paid, and the common shareholders will have to forego their dividend until the company is profitable enough to pay both. Another very common attribute of preferred shares is the liquidation preference, which means that if something were to go wrong, if the company were to have to file for bankruptcy, or if the bank were to come calling in a line of credit or something to that effect, the preferred shareholders are going to receive preferential treatment in that scenario. So the common shareholders may lose all of their capital, and the preferred shareholders may get paid back, or may get at least partially paid back. So other privileges and features that you may see associated with preferred stock: conversion privileges. Sometimes a company may negotiate the option for preferred shareholders to convert those shares into common shares at some point in the future. And if you're preferred shareholders, this is attractive because typically you'll have a dividend associated with the preferred shares that has a preference feature. That dividend may also have a higher yield than the common stock, so you can get paid and you have greater certainty with regard to that payment and with regard to that yield. But then a conversion feature also allows you to participate in the upside of the common stock if the company should happen to execute on its business plan in a way that creates the next tech high flyer, or Apple or Google or Twitter or Facebook or LinkedIn or what have you. That's a very nice feature for preferred shareholders to have, because they can get paid now through that dividend, and they can also get that potential windfall event in the future if things go right. Second on this slide, we have the participation feature, which allows preferred shareholders to share ratably in the common shareholders' dividend. Here again, they may not get a guaranteed dividend; they may just get a participation feature. This is another negotiated term that's between the preferred shareholders and the common shareholders. Slide 8 here shows an example of what you might see in sifting through the financials of a publicly traded company. In this case, Dow Chemical's convertible preferred stock. I'd just point out here a couple of terms, and these are great. Oops, let me go back here. Okay. All right, follow my cursor. I can't highlight this on the PowerPoint presentation, but if you kind of look at this cursor, this convertible preferred stock was issued by Dow Chemical Corp., and it was issued during the low of the Great Recession. So I think Lehman Brothers had probably just collapsed here, or Bear Stearns for sure. April 1, 2009. So yeah, Lehman Brothers had just gone under. The Federal Reserve had just stepped in to back a couple of the nation's largest banks. There was real panic in the market, and Dow Chemical needed to raise financing. And the banks were all going through a crisis, so nobody wanted to lend basically what amounted to about $3 billion worth of capital here. So where do you go? Well, you go to one of the deepest pocketed investors in the world, Warren Buffett, a la Berkshire Hathaway here, and you negotiate terms of preferred stock. And to Buffett's credit, look at these terms. He negotiated the purchase of preferred stock. So Buffett, and when I say Buffett, I mean Berkshire Hathaway, bought preferred stock from Dow Chemical that paid Berkshire Hathaway shareholders 8.5% annually. 8.5% annually. And it says, down here it says, any past due and unpaid dividends will accrue additional dividends at a rate of 10% per year, compounded quarterly. Okay, let's continue on. If dividends are deferred for any 6 quarters, the preferred series, a shareholder may elect 2 directors to the company's board of directors until all past due dividends are paid out. That's expensive. So if Dow can't meet that 8.5% interest rate, then Buffett gets to appoint 2 members to their board. And it says, then it goes on to give some more terms here, and one of those additional terms are also the convertible nature of the preferred. So Buffett basically negotiated a deal where he's going to get paid 8.5%. If Dow defaults, he gets 2 board seats, and if Dow doesn't default and the economy rallies, which, let's face it, Buffett's been through enough of these economic recessions to know the way the markets work. A company like Dow Chemicals is not going to go bankrupt. So when the economy goes through those natural ebbs and flows, and it's no longer ebbing, but it's flowing, meaning that we're not in an economic recession, we're in an economic expansion, then Dow Chemicals' fortunes are going to rebound. And that conversion privilege that he negotiated into this preferred stock issue is going to be very valuable. And that conversion feature broke out like this. So each share of that convertible preferred was convertible into 24.201 shares of common stock. On or after, this is the 4th bullet point here, on or after the 5th anniversary of the issuance, if the common stock price exceeded 53.72 per share for any 20 trading days in a consecutive 30-day window, Dow Chemical has the option to convert the preferred Series A into common stock. Okay, so that's a point that goes back in Dow's favor. Now both Berkshire and Dow have the right to convert that preferred stock back into common stock. So what does that do for Dow? Well, for Dow, if they convert that, then they're no longer on the hook for that 8.5% dividend that they've committed to with regard to that preferred, and that frees up a lot of cash internally. 8.5%. That's an expensive line of funding. Dow would much rather go to the bank and borrow money at 3%, 4%, 5% than engage in this transaction with Buffett and have to pay him 8.5%. That's expensive financing. So really pretty interesting deal. And I haven't gone back to look at Dow Chemicals stock price in a while through that period. But last time I did, and I know this still holds, that was a very, very profitable transaction for Buffett. So, okay, here's another example of P&G's preferred stock. I'm going to let you kind of walk through that on your own time. Only just to say here again that this is regarding the ESOP, and I want you to think of that ESOP as, that ESOP is basically just another investor, like Berkshire was in Dow. Only the employees, in this case, negotiate the terms of the stock issuance, that has been issued to the ESOP. So check that out. Spend a little time with that. And let's move on to IBM's common stock here. And we looked at this once already. And on this slide, I just want to point out a couple of additional terms. So one term is the difference between issued and authorized shares. So IBM filed a charter with the SEC, and when they filed their paperwork, the SEC authorized them to potentially issue as many as 4.6 billion shares. Now that doesn't mean they're going to go out into the market and issue 4.6 billion shares. The way markets normally work is that companies will seek permission from the SEC to issue a bunch of shares, and then they will actually issue only a slight portion of those shares, leaving them some additional flexibility to go back to the markets when and if they see fit over the period of the next 2, 3, 5, 10 years. And as they do so, they'll engage in treasury stock transactions, which, if they issue new shares, that's called a secondary offering. If they buy back those shares in the marketplace, that's called a treasury share repurchase, or just a stock buyback. And you see treasury shares reported here in the fourth bullet point, where it says IBM has repurchased 1 billion shares from its shareholders over this time period, whatever that time period happens to be. So market capitalization, I think most of you are familiar with market capitalization at this point, but if not, just make sure that you refamiliarize yourself with this terminology, because it's very, very common in the field of investing. We're simply taking the shares outstanding, IBM shares outstanding here of 1.1 billion, and we're multiplying that times the current market price per share. And that's a number that you get off Yahoo or Reuters or Morningstar or a lot of the sources that we've already taken a look at. So in this example, the market price per share for IBM was $191, and they had 1 billion shares outstanding, making IBM's market cap $214 billion. So theoretically, I want you to think of this number as what it would cost to buy IBM. If you decided as an investor that IBM was a company that you wanted to own outright, and you took your checkbook out and wanted to write a check to buy IBM, you would stroke that check for $214 billion. And then you'd own the company. You'd own all of its assets. You would own all of its intellectual property. You would in effect have installed yourself as the CEO, chairman of the board, full board, and you'd be making all the decisions. And you'd also be responsible for IBM's liabilities. So any debt that it owned to the bank, any debt that it owned to its vendors, suppliers, employees, basically all the transactions that we've been reviewing this quarter. Now, that is not in effect exactly how it would work, because this does happen in the marketplace, typically not with companies the size of IBM. You'll see companies that are $5, 10, 15, $20 billion be bought out periodically by larger private equity firms, investors groups, larger competitors, strategic borrowers, etc. And when those buyers do stroke that check, it's usually at a significant premium to what the market capitalization would indicate. And that premium is called the control premium. So just be familiar with those terms for this class. And then as you continue on your degree track, you will come across this again in a lot of the programs within the Masters of Science and Finance curriculum. So let's move on to P&G stock. You have, here again, you have common stock stated at par, issued and authorized. We've touched on that. And let's look at a simple transaction, just so that we're familiar with the debits and credits of these transactions. When a company like IBM issues stock, so in this example, we're issuing 100,000 shares. Those 100,000 shares have a par value, again, of 20 cents. Think of that as being rather arbitrary. The market value price of the stock is $43 cash per share. So the difference between 43 and that 20 cents par value is going to be the additional paid-in capital. So in this transaction, we have cash that amounts to $4.3 million, and that's the easy one. Anytime we're dealing with cash, That's a good place to start when we're breaking down debits and credits. So cash inflow, that's going to be a $4.3 million debit. And then we're going to have a credit against that for our equity. The contributed capital is going to break down between common stock, meaning the par value, which we know is 20 cents. So 20 cents times 100,000 is going to be 20,000. And then the additional paid-in capital is simply the difference. So you can think of that as kind of like a plug number, the difference between 4.3 million and 20,000. And that's the transaction. Not too terribly complicated there. Let's look at another one. In this example, we have the repurchase of stock illustrated. So this scenario is one where IBM is repurchasing 3,000 shares that were previously issued for 43. They're going to repurchase them for 40. So not a terribly great deal here. No, I take that back. I take that back. They issued them for 43, and now they have the opportunity to buy them back for 40. So they collected $43, and they're going to buy that same share of stock back that they issued for 40. So they will profit $3 in this transaction. And profit is not the technically right term to use here, because that quote-unquote profit won't flow through the income statement, but you can see the transaction here. We repurchased common shares. That's a cash transaction, so $120,000 in cash flows out the door when cash is leaving the company. That's a credit. So our corresponding debit is simply going to be treasury stock. Okay. So now assume that those shares, those 3,000 shares, are subsequently resold for 42 cash per share. Okay, so we have cash again, 126,000. The treasury stock is the corresponding credit of 126,000, and now we have $6,000 additional paid-in capital. So here you can kind of sort of see the benefit to the firm. I had called it profit. You might refer to it as gain. It's not profit. It's not gain. It's a benefit insofar as it increases the equity value of the firm, and that in turn increases what the firm's worth. So stockholders and a company can benefit from treasury stock transactions, but they affect the equity value of the company, and this is exactly how they do it here. You buy back stock, and then when it's reissued, that additional $6,000 flows into additional paid-in capital. It flows into equity. And you can think of that flow as being similar in nature to profit or to gain, which similarly flow into equity as retained earnings. Both amounts show up in the equity section. Both amounts influence the book value of the firm. Both amounts are benefits to common shareholders. Okay, on slide 17 here, we are looking at the sum total of IBM's treasury stock transactions, and those will always be presented in the balance sheet. I won't dwell on those. What I do want to move into is the accounting for stock options. And this one is technical. This one's technical. I mentioned in, let's see, I think it was module 5 when we looked at the difference between GAAP financials and IRS financials, that periodically the temporary timing differences between those two sets of books, meaning GAAP and IRS, would result in differential tax treatment of expenses. So we specifically talked about temporary differences that resulted from depreciation schedules, for example, that would lend deferred tax assets and deferred tax liabilities being recorded on company financials. Well, in Module 8 here, we're talking about the accounting for stock options. And stock options similarly create deferred tax assets, because stock options are expensed when they're issued for GAAP, but stock options are expensed when they're exercised for our IRS financials. And that creates a temporary difference. And how we deal with that difference is shown here in this example. So I want to walk through it a little bit here. And I kind of poked some fun at myself when we were in Module 5, because the technical nature of the difference in the temporary effects has always caused me trouble. So, and I think it's one of those things that causes a lot of students trouble. And if we take it slow and try to be deliberate about walking through the nature and the flows of these entries, then we can make sense out of it. But it is very technical in nature. So let's look at these transactions, and then I will also direct your attention to a section of the book that hopefully will make this more clear. And then I would just kind of encourage you to spend some time with it, because, like I said, if it is difficult for me and has been difficult for me in the past, then it's a pretty safe bet that it's been difficult for others. So in this first transaction here, years 1, 2, 3, and 4, a company grants 100,000 stock options with a fair value of $10 per share, vesting over 4 years. So the contributed capital is $250,000 in additional paid-in capital. That is a wage expense, and that wage expense is the fair value of those options at the time of issuance. And that fair value will be determined by the Black-Scholes options pricing model. And you'll learn a lot about the Black-Scholes options pricing model when you take options from Dr. Clark. In this class, we're not going to be so concerned about that options pricing model. Just know that there's several inputs that goes into it, and you can think of the value of those options as being a given for our purposes. In this case, the value of those options at the time of issuance is $250,000, and that's a wage expense. So we record it as a debit to wage expense. That wage expense serves as a reduction to the taxes that we will show on our GAAP financials. Here's the problem. Our IRS financials won't show this deduction in the year of issuance. Our IRS financials will show no benefit for this tax expense in year 1. Therefore, when we book this tax expense on our GAAP financials, we will also book a corresponding deferred tax asset, meaning that in this year, we're paying taxes. We're paying taxes on our IRS financials that are in excess of what we're actually going to show on our GAAP financials. That results in a deferred tax asset being booked on our GAAP financials. So you have the total transaction over here: wage expense $250,000, deferred tax assets in the amount of $87,500. There again, you're going to take the statutory tax rate and multiply it times the wage expense. And then our corresponding credits are going to be tax expense for $87,500 and the additional paid-in capital for $250,000. Okay, fast forward. Now we're going to look at the exercise of those 100,000 stock options. So they're exercised here at a price of $26 a share. And this is a year later, 2 years later, 3 years later. At any rate, like I mentioned, IRS allows that deduction to take place at time of exercise. GAAP allows that deduction to be booked at time of issuance. So we have that temporary difference, and in this second transaction here, that temporary difference is reversing itself. So at time of exercise, we have a cash event. The company is going to receive cash for the strike price of those options. That strike price is 26, so 26 times 100,000 is 2.6 million. That's a debit to cash. And since we are now issuing those shares, we have 2.6 million in additional paid-in capital. Now in this third transaction, we're going to deal with the tax effects of that. So the tax effect of the exercised stock options is now 2.6 million times the statutory tax rate, resulting in a deferred tax asset of $350,000, which is going to be a credit to the deferred tax asset. And then the corresponding liability would be a debit to taxes payable. Now, I want to take you over to the book. This is our book. This would be page 811. At the bottom of page 811, it gives some additional detail of kind of what we're dealing with here. I just want to read this together in hopes that it would shed some clarifying light on how these transactions actually take place. So it says, continuing with our example here, the company reports a deferred tax asset to recognize the future tax deduction of the compensation payment. Specifically, the company reports a deferred tax benefit of $87,500, which was the $250,000 wage expense times the 0.35 or 35% statutory tax rate. And they do that in each of the 4 years of the vesting period to reflect the expected reduction in future tax liability when the options are exercised. Thus, the after-tax stock option compensation expense is $162,500, computed as $250,000 in wage expense less the tax benefit of $87,500. So each year the company increases the deferred tax asset account on the balance sheet by $87,500. The balance grows until the fourth year when the deferred tax asset balance is $350,000. So in our example, all of those stock options were exercised at once, so we reduced the total deferred tax asset account down by $350,000, thereby reversing all of those prior transactions in one fell swoop. Okay, now, there's one nuance to this. When those stock options are reversed, they're not necessarily reversed at the same intrinsic value. Stock prices can go up, stock prices can go down. In this example, I think we were using an exercise price of 26. What happens if the stock price went not to 26, but to 36, 46, 56? That can be an incredible value that we're giving to the employees in terms of stock options. And that's addressed in this little footnote at the bottom of the page that says the tax benefit the company receives is based on the option's intrinsic value, meaning the current stock price less the strike price, on the exercise date. Often the exercise date intrinsic value is greater than the grant date fair value. That's the scenario I just mentioned. Recall that deferred taxes are recorded based on grant date fair value. Okay. Thus, the tax benefit received is often larger than the deferred tax asset. So in this case, the authors are telling us what happens when the deferred tax asset, meaning the tax benefit received, is greater than $350,000. So when that occurs, in that case, any tax benefit in excess of the deferred tax asset is included in additional paid-in capital and not in net income. The excess tax benefit is classified as cash from financing activities on the statement of cash flows. Okay, there you go. That's probably the most technical transaction that we're gonna see in Module 8. So take your time, review it once or twice, make sure you have a good understanding of it, and hit me back with any questions. Okay, now we can move on past it to slide number 19 and look at an example of IBM stock option program. So here's the typical disclosure that you might see in your 10K for stock options that have been issued. I would just point out here that IBM notes in the fine print that they've issued $1 billion in stock options. That was just in 2012. For those $1 billion in stock options, they received $785 million in cash, and the tax benefit associated with that was $341 million in cash. So make sure you check that out for your assigned companies and look closely as it relates to your semester project. Cisco stock options are presented in a similar format. Now Cisco takes those stock options and costs them back to the specific cost center. And when I say cost center, I mean they want those options associated with sales professionals, research and development, sales and marketing, general and administrative expenses. The stock options are presented to employees. Employees work in different cost centers. Some of those employees work in sales. Some of those employees work in research and development. Those costs should be associated with those cost centers. And this table shows how Cisco, in particular, as one example, takes those costs and reallocates them back down to the specific cost center. So Here again, you see a lot of different formats that companies will use, both internally and externally, to present numbers to the public. Typically done to provide them with the most insightful and useful method for analyzing their business and getting a handle on that true fundamental underlying economic reality. And that's one of the tough parts about being a financial analyst, is that we have to really dig in to understand how a company is presenting some of these numbers. Okay, slide number 21 takes a look at another transaction whereby this company, I don't know if we're still dealing with Cisco here, but this company issues 100,000 shares of restricted stock with a market value of 26, vested over 4 periods. So similar to stock options, but not stock options, rather restricted stock. This first transaction will look familiar. So we don't have any cash coming in, but we do have deferred comp. So we've issued restricted stock, which is not comp today, it's deferred comp. It'll be real comp when it actually vests. So we have additional paid-in capital of $2.6 million, and we have deferred comp, which would be the deferred comp would be the debit in this case. Additional paid-in capital would be the credit. Now, in the second transaction, which occurs in years 1, 2, 3, 4, is to record that compensation expense, which would be associated with that deferred comp. So we have a wage expense of $650,000 in the second transaction. We have the taxes payable associated with that, and then the offsetting credits would be deferred comp and the taxes expense. So here's an example of how you might see restricted stock reported on an income statement. Okay, moving on. Let's look at the accounting for earned capital, cash dividends, stock dividends, and comprehensive income. Okay. Dividends. These two terms, I hope, are familiar. They're fairly straightforward in nature, but they're technical terms, and we need to be familiar with dividend payout, which you often hear referred to as dividend payout ratio, and that ratio is simply dividends divided by net income attributable to controlling interest. So if a dividend payout is 6%, this would be the computation of that, and you also see that presented as the second term here, which is dividend yield, or dividends per share divided by the current share price. And dividend yield, you often hear 3%, 4%, 5%. The higher the dividend yield, the more attractive that dividend oftentimes is to shareholders seeking a yield on their investment. Last week or 2 weeks ago, we invited the UMKC team in to present CapFed. CapFed had a healthy dividend yield of about 6%. And that team made a good case for why that was appealing to a certain subset of investors. So the accounting for that, when we book a dividend, we have cash going out the door, and that cash is a direct reduction to retained earnings. Oops, let me go back one here. So let's look at an example. Let's assume a company has 15,000 shares of $50 par value, 8% preferred stock outstanding, and 50,000 shares of $5 par value common stock outstanding. So during its first 3 years in business, the company declares $20,000 in dividends in the first year, $260,000 of dividends in the second year, and $60,000 of dividends in the third year. I want you to remember back to the different features associated with preferred stock. One of them was a preference feature, meaning that the preferred shares would get paid first. So in this example, we have 15,000 shares. This is the first bullet point again here. We have 15,000 shares of $50 par value with an 8% preferred stock outstanding. So if we take 15,000 shares times a $50 par value, that equals 750,000 par value. Multiply that times an 8% yield, and we get a $60,000 preferred dividend that's due those preferred shareholders every year. Let's look at how that breaks down. So in year one, we were told that the company issued $20,000 worth of cash dividends. So we have 15,000 times 50 times 8%. That calculates to 60,000. But the company only issues 20,000, so it only pays 20 of the 60 that it owes, leaving $40,000 in arrears, meaning $40,000 is owed to those preferred shareholders, and that's going to have to be made up before common shareholders can receive anything. And you'll see here that that's made up in year two when the company declares $260,000 worth of dividends. So now the preferred shareholders receive $20,000 that they're owed from last year, $40,000 that they're owed from last year, $60,000 that they're entitled to from this year, and then the balance of what the company declares can actually be paid out to common shareholders, in which case $160,000 in cash would flow to common shareholders in this instance. Okay, moving on, we see Exhibit 2 here, which again is a nice cheat sheet. Star this one for the exam. You're going to want to be able to come back to this one. So we look at the percentage of outstanding shares distributed in a stock dividend. We're talking about a transaction whereby, in lieu of cash, a company will issue new shares to a stockholder, which is a little bit of a shell game, because stock in itself is nothing more. You can think of stock in itself as nothing more than a pie chart, and the more stock that we have issued is simply the more pieces of the pie that we've cut the business up into. And to issue more shares of stock is nothing more than just cutting the pie up into more pieces. So sometimes you see this almost as a gamesmanship type activity. When a company's falling on hard times and they can't afford to pay a real dividend, they'll issue a stock dividend. And I would encourage you as an analyst to look very, very closely at any company engaging in a stock dividend, because it's just curious as to why they would actually do this. But we need to understand the accounting for stock dividends and how it actually breaks down in practice. And there's a difference between whether or not there's a difference between how we account for it depending on the magnitude of it. In this case, the threshold is less than 20% or more than 20%. Let's look at this top line here, less than 20%. In that instance, we will reduce retained earnings by the market value of shares distributed. Common stock and the contributed capital, you'll see that the common stock is increased by the dividends per share times the par value per share, and the additional paid in capital is increased for the balance. In the instance where we have more than 20% of a stock being distributed as a dividend, we will reduce the par value of shares distributed, and the common stock will be increased by the dividends per share times the par value. So let's look at an example here. Assume that a company has 1 million shares of $5 common stock outstanding. It declares a small stock dividend of 15% of the outstanding shares when the market price of the stock is $30 per share. The small stock dividend is as follows. You would see that that retained earnings debited for $4.5 million. And remember, the normal balance of retained earnings is a credit, so that's going to serve as a reduction to the normal balance. Then we're going to credit common stock for $0.75 million, and we're going to credit the balance to additional paid-in capital of $3.75 million. So that's a typical transaction for a small stock dividend. Now let's look at a large stock dividend, whereby the stock dividend amounts to 70% of the outstanding shares. This is basically calculated for as a stock split. It's not quite a stock split where you would increase the value maybe 2-to-1. That's the most common ratio. So in effect, you're just doubling the amount of shares that you have outstanding. In this stock dividend, we're increasing the amount of shares outstanding by 70%, which is a rather arbitrary number, but nonetheless, in that transaction, you would see retained earnings debited by $3.5 million, and the offsetting credit would be simply common stock, and that results in a fairly straightforward transaction. So the authors give us a specific example here on slide 30. Stock splits. This is a stock split whereby TJ Maxx in this example is initiating a stock split. And notice that they or rather, I want you to just pay attention of how these stock splits work, because the denominator of a lot of the ratios that we've looked at throughout the semester will change, meaning that the shares outstanding are different. And that means that we have to have the presence of mind and the wherewithal to go back retroactively and adjust any ratios that are relying on shares outstanding in their denominator, most commonly, for that issuance. So we have to adjust that retroactively if we're going to be able to draw any meaningful conclusions from time series analysis. So let's take for example a simple one. If we want to look at earnings per share over time, meaning earnings per share from 2010, 11, 12, 13, 14, 15, well, if we had a stock split or a stock dividend in there somewhere, then that's going to dramatically affect that earnings per share calculation. And we have to have the presence of mind to know that that's going to require some work on our part as the analyst to go back in time and retroactively adjust those financial statements in a way that allows us to make meaningful comparison of that data over time. So I just wanted to pause there and give you some insight into the job of being a financial analyst and highlight some of the adjustments that we actually have to make over time. Moving on, let's take a look at other comprehensive income. So I mentioned that this falls below net income on the income statement. This is a unique categorization of gains and losses and other adjustments that will affect our business over time, and there are 4 broad categories, and those broad categories are from left to right here: net unrealized losses and or gains on cash flow hedges, foreign currency translation adjustments, the net change in retirement related benefits from defined benefit pension plans, net unrealized gains and losses on available for sale securities, and those 4 categories flow into other comprehensive income or loss, which will show up on the income statement, and then the resulting accumulated line item will show up on the balance sheet in the statement of shareholders' equity here for IBM, totaling $25 billion worth of accumulated other comprehensive loss. And we will go into a couple of these in more detail in latter modules. In this module, we're going to talk a little bit about foreign currency translation adjustments. But you see here on slide 32 that the authors give us some additional detail on IBM's OCI. We just call it OCI, meaning other comprehensive income. The first one here, cash flow hedges, we'll talk about a little bit in Module 9. Foreign currency translation adjustments we'll talk about in Module 8. And then defined benefit plans we'll talk about in Module 10. And net losses on available for sale securities we'll talk about Module 9. So let's just put a placeholder in each of those for a later date and move into foreign currency translation effects today. And we've touched on this briefly in previous modules. When a conglomerate and in particular, a global conglomerate, take Apple for example, that sells iPhones in Europe and China and around the world, has to report its financials. Well, we need to recognize as analysts that when Apple sells an iPhone in China, the Chinese consumer doesn't walk into the Apple store with dollars. They walk into the Apple store with yuan or renminbi, and they pay for that phone with that foreign currency. And Apple will collect that foreign currency throughout the year, and at the end of the year, they're going to have a bank account in China that's denominated in that foreign currency. And that bank account might be many, many billions of dollars. Well, Apple is beholden to US GAAP, and US GAAP requires that Apple report its balance sheet in US dollars. So they have to take that Chinese balance sheet and translate it into US dollars. And that translation is beholden to the yen per dollar exchange rate at that point in time. And that exchange rate can fluctuate wildly throughout the year. And we translate that balance sheet at whatever that exchange rate is at the end of the year. And we also translate the income statement at the average exchange rate throughout that period of time. And that can result in gains and losses that are explicitly due to movements in that exchange rate. And because those exchange rates can be so volatile, GAAP allows us to put those gains and losses in OCI. And Exhibit 8.3 here is your cheat sheet. So look at the first line. As the US dollar weakens, our assets increase, and our liabilities increase, and our equity increase. As the US dollar strengthens, our assets will decrease, our liabilities will decrease, and our equities will in turn decrease. Okay, and that is a very basic overview of foreign currency translation gains and losses. There's more to that conversation. We won't go into great depth in this class. The authors do a good job of drawing it a little bit out in your text. I will refer you to the text for greater detail, but the exam won't go into great depth with regard to foreign currency translation adjustments and losses. So let's move on to non-controlling interest. This is another topic that we've touched on a couple of times this semester already. Again, non-controlling interest is that line item that companies report when they buy a subsidiary, for example, but it's only a partial portion, leaving another portion still owned by a smaller group of shareholders, in which case we, meaning the reporting company, will be required to report the net income due to those non-controlling shareholders that have a partial claim on both cash flows and earnings that the company generates and the total equity that's reported on the company's balance sheet. So here we can see Walmart, which is a huge multinational conglomerate. We would expect Walmart to have a non-controlling interest that had resulted from some transaction that they've engaged in the past 50 years. And sure enough, we show revenues less expenses, sum totaling to consolidated net income. And then from that subtotal, we subtract net income attributable to non-controlling interest of $757 million. Footing, or footing's that accounting term that simply means the total at the bottom of the page. So this foots to consolidated net income attributed to Walmart of $16.999 billion. That's the number I want you to focus on for your semester assignment, $16.999 billion, or the net income associated with basic shares outstanding, because that's what we're trying to put a value on. That's what allows us as analysts to come to some determination around the market value of a share of stock for our assigned companies. We need to be able to determine what Apple or Walmart or Microsoft is worth on a per share basis. And we're going to take that per share valuation and we're going to compare it to the number that we get when we type the ticker symbol into Yahoo or Microsoft or Morningstar. And if that valuation is greater than the number that we see when we type in that ticker symbol into Yahoo, then we have opportunity in the marketplace to take advantage of a mispricing and potentially put capital to work in a way that will make either us or our shareholders money through our investing activities. That's what it's all about in pursuing this example as this semester-long shareholder example. And therefore, we have to focus on income to basic shares outstanding.